Hi all, this is Ruskin Felix. Welcome to my channel. Today we are going to be talking about the compounded annual growth rate, which is called the CAGR in business parlance. These are a series of videos that I'll be making for making you understand what are the basic or what are some of the basic concepts in finance. If you are looking at this, you should be looking at other concepts as well, which will be helping you in understanding a lot of terminology and words used inside finance. Now, coming to CAGR, what is CAGR? It is basically the compounded annual growth rate. It is basically the rate of return that would be required for an investment to grow from its beginning balance to its ending balance, assuming the profits were reinvested at end of each year of the investment lifespan. So now explaining what it is, if the difference between simple interest and compounded interest is exactly this. When I am taking simple interest, for example, I take 1 lakh rupee loan, my 1 lakh rupee loan and there's a 10% simple interest. On 10% simple interest, I will always be paying only that 10%, 10%, 10%. And that's why simple interest will always be the same. But with compounded interest, if the compounding rate is 10% and that is happening annually, then your first year you will pay 10% on 100, which is 110. But because you're reinvesting that 10 rupees back, now your total sum is 110. And so now when you calculate 10% on 110, it is 11 rupees. And so your next value will become 11, and so your total value after that will become 121. This is essentially what is compounded annual growth rate. In this, instead of interest, there is a growth rate. And so you have to expect that the investment profits that come out of it are reinvested into the business, and that is why the compounding will keep happening. Now, in terms of the overall CAGR formula, it is nothing but the ending value divided by the beginning value. This gives you the ratio, and this will be made to the power 1 by n and minus 1. So it is essentially what they're doing is basically that they're doing a book value by EV to the power n minus 1. Now, for calculating the CAGR of an investment, first you divide the value of an investment at the end of the period by its value at the beginning of the period. So ending value by beginning value will give you a ratio. Now this ratio, raise this result to the exponent of 1 divided by number of years. So how many number of years? Now remember, this is number of years, but this is actually number of period. So if someone says that your compounded annual growth rate is compounding every quarter, how many quarters in a year? 4. So this means if I am compounding something for 4 periods, it will happen that I have compounded 2.5 rupees on that 10% of 100. Then 102.5 I have computed 2.5%. So that is how it happens. So you have to remember this aspect, that it is not number of years, it is actually number of periods. In this case, because we are using years, we have used it years here. And then subtract the whole result by minus 1. This will give you the percentage. I've showed you the CAGR example as well, where the actual investment fluctuates at the end of the value, but there is a smoothing effect of the CAGR even if the actual investment value keeps decreasing or increasing. So instead of your investment going from 1000 to 2500 to 3000, it actually has, and then coming back down, what your overall growth is 1000 to 1500, which is 50%. So in a 2 period situation, where this is 2 years situation. I hope this helped you a lot. Please go have a look at all the other videos as well in terms of concepts. If you haven't subscribed yet, please subscribe. I'm making a lot of content and that will keep coming for you all to see, including live sessions, stock tips, stock understandings, updates in industries, stock market analysis, basically everything that you would need to make money. Thank you so much. Bye-bye.